Question 1. Which of the following is a primary reason for requiring underwriters to use risk classification when evaluating potential insurance policies? A. To ensure that premiums are higher for all customers. B. To balance the insurer's portfolio by ensuring that only high-risk individuals are insured. C. To provide fair, equitable rate based on an individual's or business's risk profile. D. To avoid discrimination against individuals with certain health conditions. Answer: C. To provide a fair, equitable rate based on an individual's or business's risk profile. Explanation: risk classification is essential in insurance underwriting because it helps to determine the appropriate premium based on the individual's or business's risk factors. These factors can include health conditions, occupation, claims history, and other risk-related variables. The goal of risk classification is to ensure that the premium charged reflects risk level posed by the insured. This approach helps to keep the pricing fair and equitable, ensuring that individuals or businesses with low risks do not subsidize those with high risks. It is in alignment with state regulations, which require that underwriters must avoid discrimination and follow fair practices. Question 2. Scenario: Mr. Thompson, a homeowner in Alaska, recently applied for homeowners insurance. The insurance underwriter is considering his application but has noticed that he lives in a remote area prone to wildfires and his property has a history of small previous claims. How should the underwriter approach the decision? A. Approve the application without any further evaluation since his property is in a rural area. B. Deny the application outright due to the remote location and previous claims. C. Evaluate the potential risk and consider applying a higher premium or imposing exclusions for wildfire damage. D. Approve the application, but only for coverage of the home's contents, not the structure. Answer: C. Evaluate the potential risk and consider applying a higher premium or imposing exclusions for wildfire damage. Explanation: in this scenario, the underwriter needs to consider the potential risk posed by the remote location and previous claims. While living in a remote area with wildfire risk may require special attention, it does not necessarily lead to an automatic denial of coverage. The underwriter should evaluate the applicant's profile considering factors such as previous claims history and the specific risk of wildfires in the area. Based on this assessment, the underwriter can apply appropriate risk mitigation strategies such as charging a higher premium or including exclusions for wildfire damage. This is in line with the underwriting process where the risk should be adequately priced and covered in a way that protects the insurer while being fair to the applicant. Question 3. Which of the following is an example of moral hazard that an underwriter should be aware of when assessing a new insurance application? A. A person who refuses medical treatment for a serious condition due to personal beliefs. B. An individual who exaggerates the value of their property to increase the payout on a claim. C. A business owner who invests in better fire prevention systems to low risk. D. A person who submits a claim after a minor car accident with no damages. Answer: B. An individual who exaggerates the value of their property to increase the payout on a claim. Explanation: moral hazard occurs when an insured individual or entity takes on higher risks because they know they will not bear the full financial cost of that risk. In this case, exaggerating the value of the property in order to increase the potential payout is an example of moral hazard. This behavior could lead to increased fraudulent claims. Underwriters need to be cautious of when reviewing applications. Insurers often assess moral hazard by evaluating the applicant's honesty and reliability, considering factors such as their claims history and the consistency of their application information. Identifying and managing moral hazard is critical in maintaining the integrity and profitability of the insurance process. Question 4. Which of the following is the most appropriate action an underwriter should take when evaluating an insurance application that includes an applicant with a prior history of frequent claims? A. Approve the application and issue a policy without considering the claim history. B. Deny the application due to the prior claims history. C. Approve the application with a higher premium to account for the increased risk. D. Approve the application only if the applicant provides an explanation for each past claim. Answer: C. Approve the application with a higher premium to account for the increased risk. Explanation: underwriters must evaluate an applicant's claims history to assess the risk associated with issuing new policy. History of frequent claims suggests higher level of risk, but this does not necessarily lead to an automatic denial of coverage. The appropriate action is often to approve the application but apply a higher premium to account for the increased risk. Ensures the insurance company is adequately compensated for the higher likelihood of future claims while offering the applicant coverage. Underwriting guidelines and state regulations require that insurers charge rates commensurate with the level of risk to ensure fairness and financial solvency. Question 5. Which of the following underwriting tools is primarily used to assess the financial risk of insuring a business? A. Personal credit score. B. Loss run report. C. Business financial statements. D. Risk classification system. Answer: C. Business financial statements. Explanation: when underwriting business insurance policies, underwriters focus on assessing the financial stability of the business. The business financial statements, e.g., balance sheet, income statement, cash flow, provide key insights into the business's ability to withstand financial losses. These statements are a crucial part of evaluating the risk associated with insuring the business, as they help understand factors such as liquidity, profitability, and solvency. Other tools like loss run reports or credit scores may also be used, but the business financial statements are the most direct way to assess financial risk in commercial underwriting. Question 6. Scenario: Samantha is applying for health insurance in Alaska. During the application process, she discloses that she has a pre-existing medical condition. Based on this information, what should the underwriter consider when making the decision? A. Deny the application outright due to the pre-existing condition. B. Approve the application with a rider or exclusion for the pre-existing condition. C. Approve the application without any adjustment since the condition was disclosed. D. Approve the application with a higher premium but no exclusions or riders. Answer: B. Approve the application with a rider or exclusion for the pre-existing condition. Explanation: in health insurance underwriting, pre-existing conditions are an important factor to consider. Underwriters are allowed to evaluate the potential impact of the pre-existing condition on the applicant's future claims and may apply exclusions or riders that limit coverage for that specific condition. This practice ensures that the insurer is not assuming an unfair level of risk. However, underwriters are generally prohibited from outright denying coverage based solely on pre-existing conditions in many states, including Alaska, which has specific regulations that require insurers to treat such conditions fairly. Applying rider or exclusion is a common approach that addresses the increased risk without denying coverage. Question 7. Which of the following best describes an underwriter's role in the insurance application process? A. Underwriters are responsible for selling insurance policies to potential clients. B. Underwriters are responsible for setting insurance premiums and approving or rejecting applications based on risk assessment. C. Underwriters ensure that all claims are paid accurately and on time. D. Underwriters manage the claims investigation process to determine fraud. Answer: B. Underwriters are responsible for setting insurance premiums and approving or rejecting applications based on risk assessment. Explanation: underwriters play a crucial role in evaluating the risk associated with an insurance application. They assess the applicant's risk factors and determine the appropriate premium to charge based on this evaluation. The underwriting process involves examining the applicant's information such as claims history, financial stability, and any other relevant risk factors. While underwriters do not sell insurance policies, which is the role of agents or brokers, they do have the authority to approve or reject applications. Setting premiums and ensuring that the risk is appropriately priced is one of their primary responsibilities in the insurance process. Question 8. Which of the following statements about moral hazard is true? A. Moral hazard only applies to individuals who engage in fraudulent activities. B. Moral hazard occurs when an insured individual takes on additional risk because they do not bear the full financial cost of that risk. C. Moral hazard is solely related to property insurance policies. D. Moral hazard does not affect the underwriting process or risk assessment. Answer: B. Moral hazard occurs when an insured individual takes on additional risk because they do not bear the full financial cost of that risk. Explanation: moral hazard refers to a situation in which an individual or business may take on more risk because they know they are protected by insurance and will not bear the full financial consequences of that risk. This can lead to behaviors that increase the likelihood of a claim, such as neglecting safe precautions or being less cautious in general. It is not limited to fraudulent activities, but rather to the general tendency of individuals to take on more risk when they are not fully responsible for the costs. Underwriters need to be aware of moral hazard when assessing risks to ensure that policies are not issued to individuals who may exploit their insurance coverage. Question 9. Which of the following is an example of an underwriting guideline adjustment that may be necessary when underwriting high-risk individuals in Alaska? A. Offering a standard policy without exclusions for pre-existing conditions. B. Increasing the policy premium to reflect the higher risk of loss. C. Providing coverage without considering past claims history. D. Offering an automatic renewal for all high-risk policies. Answer B. Increasing the policy premium to reflect the higher risk of loss. Explanation: when underwriting high-risk individuals, especially in a state like Alaska with unique environmental challenges, underwriters may need to adjust the premium to reflect the higher likelihood of a claim. For example, individuals in areas prone to natural disasters or those with a history of frequent claims may present a higher risk to the insurer. Increased premium is a common way to adjust for this risk, ensuring that the insurer is compensated for the higher potential for loss. Other adjustments, such as applying exclusions or limiting coverage, may also be used in certain cases, but increasing the premium is a key way to manage high-risk policies. Question 10. Which of the following is a primary factor when an underwriter evaluates an applicant's loss history? A. The frequency and severity of past claims. B. The applicant's age and health status. C. The applicant's credit score and income level. D. The market conditions for insurance rates. Answer A. The frequency and severity of past claims. Explanation: when underwriting, loss history is one of the key indicators of future risk. Underwriters look at both the frequency and severity of past claims to assess the likelihood of future claims. A high frequency of claims suggests a higher risk, while severe past claims can indicate a greater potential for significant losses. This evaluation is used to determine an appropriate premium and coverage limits. Factors such as age, health, credit score, and market conditions are also important, but the loss history plays a central role. Risk assessment. Question 11. Which of the following is a key consideration when determining the underwriting criteria for a commercial insurance policy? A. The size and industry of the business. B. The applicant's personal financial situation. C. The applicant's health status and age. D. The number of claims the business owner has made on personal insurance policies. Answer A. The size and industry of the business. Explanation: when underwriting commercial insurance policies, one of the key considerations is the size and industry of the business. Different industries present different levels of risk based on factors such as operations, regulations, and market dynamics. For example, a construction company is generally considered to have higher risk than a consulting firm. Size is also important because larger businesses may have more complex risks that require more in-depth evaluation and specialized coverage options. The applicant's personal financial status or personal claims history is generally less relevant for commercial underwriting. Question 12. Scenario: Mr. Thompson has submitted an application for homeowners insurance. He disclosed that he has a history of prior fire-related claims. His house is located in an area prone to wildfires. What would be the most appropriate action for the underwriter? A. Deny the application because the applicant has a history of fire-related claims. B. Approve the application but impose a higher deductible and exclude fire-related damages. C. Approve the application without any adjustments due to the wildfire risk. D. Offer Mr. Thompson a policy that covers only fire-related damage. Answer B. Approve the application but impose a higher deductible and exclude fire-related damages. Explanation: in this scenario, the underwriter needs to balance the risk associated with both Mr. Thompson's previous claims history and the increased risk posed by the wildfire-prone area. While it may not be appropriate to deny the application outright, the underwriter can mitigate the risk by imposing a higher deductible to transfer some risk to the policyholder and excluding fire-related damages. This ensures that the insurer is adequately protected from high-risk claims while still offering coverage for other types of damage. Denying the application entirely or offering only fire-related coverage would be excessive or impractical. Question 13. Which of the following best defines the term underwriting risk? A. The potential for the insurer to lose money due to fraudulent claims. B. The risk that the policyholder will default on premium payments. C. The risk that the underwriter's decision will result in loss for the insurer. D. The risk that the insurance policy will not meet the regulatory requirements. Answer C. The risk that the underwriter's decision will result in a loss for the insurer. Explanation: Underwriting risk refers to the risk that the decisions made by the underwriter, such as approving a policy, will result in a loss for the insurer. This loss could occur if the underwriter misjudges the applicant's risk, either by underpricing the policy or by failing to account for specific risks that could lead to claims. Underwriting risk is central to the role of an underwriter and is mitigated through careful risk assessment, data analysis, and appropriate pricing strategies. Question 14. Which of the following is an example of a moral hazard in underwriting? A. An applicant has a history of non-payment of premiums. B. An applicant intentionally increases their coverage limits to benefit from higher claims payouts. C. An applicant misrepresents their financial status to obtain low premiums. D. An applicant has multiple claims in a short period of time due to negligence. Answer. B. An applicant intentionally increases their coverage limits to benefit from higher claims payouts. Explanation. Moral hazard occurs when an insured party takes on additional risk or acts in ways that increase the likelihood of a claim because they do not bear the full cost of the loss. In this case, intentionally increasing coverage limits to benefit from higher claims payouts is a clear example of moral hazard. The insured party is incentivized to take more risk because they will not bear the full financial consequences. Underwriters must account for moral hazard by carefully evaluating applicants' behaviors and assessing risks accurately. Question 15. What is the main objective of using predictive analytics in underwriting? A. To increase the number of policies issued by the insurer. B. To assess risk by analyzing historical data and predicting future outcomes. C. To simplify the underwriting process by automating policy issuance. D. To comply with state insurance regulations. Answer. B. To assess risk by analyzing historical data and predicting future outcomes. Explanation. Predictive analytics is used in underwriting to assess risks more accurately by analyzing historical data and using statistical models to predict future outcomes. This allows underwriters to make more informed decisions based on trends, patterns, and probabilities, rather than relying solely on intuition or limited data. Predictive analytics helps insurers set appropriate premiums, improve risk selection, and optimize their underwriting processes. Question 16. Which of the following best describes the relationship between risk tolerance and underwriting guidelines? A. Risk tolerance is irrelevant when establishing underwriting guidelines. B. Underwriting guidelines are based solely on the insurer's risk tolerance. C. Risk tolerance defines the upper and lower limits for acceptable risks in underwriting guidelines. D. Risk tolerance is determined only after the underwriting guidelines are established. Answer. C. Risk tolerance defines the upper and lower limits for acceptable risks in underwriting guidelines. Explanation. Risk tolerance refers to the level of risk an insurer is willing to accept when underwriting policies. It defines the upper and lower limits for acceptable risks, which are reflected in the underwriting guidelines. Insurers typically establish these guidelines based on their risk tolerance, ensuring that they do not take on more risk than they can manage. Underwriting guidelines are therefore designed to align with the insurer's risk tolerance, balancing profitability with the potential for claims. Question 17. Scenario MS. Darcy owns a small boutique in Anchorage, Alaska. She is applying for commercial property insurance but has made a number of claims in the past due to water damage. What should the underwriter consider when assessing this application? A. Deny the application based on the applicant's claims history alone. B. Approve the application with an exclusion for water damage and higher premium. C. Approve the application without changes as water damage is common risk. D. Offer only liability coverage, excluding property coverage. Answer. B. Approve the application with an exclusion for water damage and a higher premium. Explanation. In this scenario, the underwriter must consider MS. Garcia's claims history, especially the frequent water damage claims, rather than denying coverage outright. The underwriter may approve the application with a rider that excludes water damage. Additionally, a higher premium may be charged to account for the elevated risk. This allows the insurer to coverage while managing the risk of water damage claims. Offering only liability coverage would be too limited and may not fully meet the applicant's needs. Question 18. Which of the following best describes an underwriter's responsibility in risk management? A. To deny all high-risk applicants. B. To issue policies that always provide the lowest premium. C. To assess and manage risks by adjusting policies to reflect the true risk level. D. To guarantee the financial success of the insurance company. Answer. C. To assess and manage risks by adjusting policies to reflect the true risk level. Explanation. An underwriter's primary responsibility in risk management is to assess the level of risk associated with an applicant and adjust the policy accordingly. This includes determining the appropriate premium, setting coverage limits, and considering exclusions or endorsements to align the policy with the level of risk. Underwriters aim to ensure that policies are issued to applicants whose risks are accurately assessed, thereby protecting the insurer's financial health and preventing large, unexpected losses. Question 19. Which of the following actions would be considered a violation of anti-discrimination laws in underwriting? A. Denying an application based on the applicant's health status. B. Offering higher premium to an applicant with history of claims. C. Using an applicant's credit score to assess their risk level. D. Offering different premiums based on geographic location. Answer A. Denying an application based on the applicant's health status. Explanation. Anti-discrimination laws in underwriting prohibit insurers from denying coverage based on an applicant's health status. These laws are designed to protect individuals from unfair treatment and ensure that insurers make decisions based on valid risk factors, not irrelevant characteristics such as health conditions. Offering higher premiums for high-risk applicants or using credit scores as part of the underwriting process, if legally allowed, are permissible as long as they are consistent with underwriting guidelines. Question 20. Which of the following is a key feature of an underwriter's role when working with high-risk or non-standard markets? A. To minimize the risks by issuing policies only to low-risk applicants. B. To assess and price policies according to the specific risks presented by the applicant. C. To ensure that all policies in the high-risk market are denied to maintain profitability. D. To offer the same standard terms to all applicants regardless of their risk profile. Answer. B. To assess and price policies according to the specific risks presented by the applicant. Explanation. When working with high-risk or non-standard markets, underwriters must assess each application individually, taking into account the specific risks presented by the applicant. This could include factors such as previous claims, industry-specific risks, or unique property risks. Policies for high-risk markets are typically priced higher to reflect an increased likelihood of claims, and specific conditions or exclusions may be added to manage the risk appropriately. The goal is not to deny coverage, but to ensure that the insurer can handle the risks while offering coverage to the applicant. Question 21. Which of the following statements best describes the underwriter's role in risk mitigation? A. The underwriter is responsible for the direct implementation of loss prevention programs. B. The underwriter assesses risk and makes decisions regarding premium pricing based on the risk level. C. The underwriter approves all claims submitted by policyholders in relation to their insurance coverage. D. The underwriter only reviews claims after they have been paid out by the insurer. Answer. B. The underwriter assesses risk and makes decisions regarding premium pricing based on the risk level. Explanation. Risk mitigation involves assessing the potential for loss and adjusting policies accordingly. Underwriters evaluate the risks presented by an applicant and determine the appropriate premium and coverage limits based on the assessed risk. While they don't implement loss prevention programs directly, their decisions help mitigate the overall risk to the insurer. Loss prevention programs are generally managed by claims or risk management departments. Question 22. A commercial underwriter is reviewing an application for a manufacturing company that is seeking property insurance. Which of the following is most important for the underwriter to assess? A. The company's stock portfolio. B. The company's risk of natural disasters in its region. C. The company's previous insurance claims history. D. The company's employee satisfaction ratings. Answer. B. The company's risk of natural disasters in its region. Explanation. For commercial property insurance, one of the most critical factors is the risk of natural disasters such as earthquakes, floods, or severe weather, particularly in the company's geographic location. The underwriter will assess how likely these risks are to impact the business and adjust the terms, conditions, and pricing of the policy accordingly. While company's claims history is important, environmental factors like natural disasters are key to property coverage. Question 23 scenario. Mr. Carter is applying for health insurance and has a history of heart disease and high blood pressure. The underwriter must decide whether to approve the application or not. What factor is most likely to influence the underwriter's decision? A. Mr. Carter's level of physical activity. B. Mr. Carter's medical history and current health status. C. Mr. Carter's job title and income. D. Mr. Carter's financial history and credit score. Answer. B. Mr. Carter's medical history and current health status. Explanation. Health underwriters primarily focus on an applicant's medical history and current health status. This includes chronic conditions like heart disease and high blood pressure, as they directly affect the insurer's potential exposure to health risks and medical costs. While other factors like physical activity or credit scores can play a role in underwriting decisions, the primary concern health insurance is the applicant's health. Question 24. Which of the following is most commonly used by underwriters to assess the risk associated with a property insurance application? A. The applicant's age and employment status. B. The location of the property and its vulnerability to risks. C. The applicant's previous property insurance carrier. D. The applicant's overall health condition. Answer: B. The location of the property and its vulnerability to risks. Explanation: the location of the property is a major factor in property insurance underwriting. Properties located in areas prone to natural disasters such as floods, earthquakes, or hurricanes present higher risks and may be priced higher or have exclusions. The underwriter will assess these geographical risks and adjust the premium or coverage terms accordingly. Question 25. What is the purpose of underwriting guidelines for commercial lines insurance? A. To set strict rules for denying applications from high-risk businesses. B. To outline standard procedures for issuing policies to all types of businesses. C. To provide underwriters with a consistent framework for evaluating commercial risks and exposures. D. To determine the exact claims payout amounts for each type of business. Answer: C. To provide underwriters with a consistent framework for evaluating commercial risks and exposures. Explanation: underwriting guidelines are essential for ensuring consistency and fairness in evaluating commercial risks. These guidelines help underwriters assess each business based on specific risk factors such as industry type, revenue, safety protocols, and historical claims data. They do not dictate strict denials, but provide a frame for making informed and consistent decisions across applications. Question 26. Under Alaska's state regulations, which of the following would be considered an unfair practice in underwriting? A. Rejecting an applicant based on their credit score. B. Discriminating against an applicant based on their geographic location. C. Offering low premiums for businesses with better risk mitigation strategies. D. Adjusting coverage limits based on the applicant's risk profile. Answer: B. Discriminating against an applicant based on their geographic location. Explanation: under Alaska's insurance regulations, as in many other states, discrimination based solely on an applicant's geographic location is considered an unfair practice. Underwriters are required to base decisions on legitimate risk factors such as loss history, industry type, and other relevant data, rather than on unfair or arbitrary factors like where the applicant is located. Discriminatory practices can lead to penalties and legal consequences. Question 27 scenario. Ms. Lin is applying for auto insurance with a history of multiple at-fault accidents. The underwriter is reviewing her application. What is the most likely impact of her driving history on the underwriting process? A. Ms. Lin will be automatically rejected for coverage due to her accidents. B. Ms. Lin will be offered the standard rate without any adjustments. C. Ms. Lin may be offered coverage at a higher premium due to her risk profile. D. Ms. Lin will receive a policy with reduced coverage limits for her safety. Answer: C. Ms. Lin may be offered coverage at a higher premium due to her risk profile. Explanation: in auto insurance, an applicant's driving history, including at-fault accidents, plays a significant role in underwriting decisions. History of accidents indicates higher risk of future claims, and as a result, the underwriter may offer coverage at higher premium to reflect that increased risk. While rejection may occur for extreme cases, most insurers prefer to offer coverage with adjusted premiums or terms to manage the risk. Question 28. Which of the following is typically not part of the underwriting process for life insurance? A. Reviewing the applicant's medical history and current health condition. B. Assessing the applicant's credit score and financial history. C. Conducting a background check for criminal history. D. Determining the applicant's age, gender, and occupation. Answer: B. Assessing the applicant's credit score and financial history. Explanation: life insurance underwriting generally focuses on factors that are directly related to life expectancy, such as the applicant's medical history, occupation, which may influence risk, age, and gender. While financial stability can be relevant in some cases, particularly for large policies, the primary focus is not on the applicant's credit score or financial history. Criminal background checks are occasionally performed but are not primary factor. Question 29. What is the role of predictive analytics in underwriting? A. To automatically approve or deny all insurance applications without human intervention. B. To assess an applicant's creditworthiness for life and health insurance policies. C. To analyze large datasets and predict future claims risks based on historical data. D. To ensure the insurer follows all legal and regulatory requirements in underwriting. Answer: C. To analyze large datasets and predict future claims risks based on historical data. Explanation: predictive analytics is increasingly used in underwriting to assess risk more effectively. By analyzing large datasets and historical claims data, underwriters can predict the likelihood of future claims, improving the accuracy of risk assessments and pricing models. Predictive analytics enhances decision-making, helps in identifying patterns, and supports more precise pricing strategies. Question 30. In Alaska, what must an underwriter do if they suspect fraudulent information on an insurance application? A. Deny the application immediately without further review. B. Investigate the claim and report the findings to the appropriate authorities. C. Ignore the suspicious information if the premium is paid. D. Approve the application with exclusions for potential fraudulent activity. Answer: B. Investigate the claim and report the findings to the appropriate authorities. Explanation: if an underwriter suspects fraud on an insurance application, they are obligated to investigate the claim and report their findings to the appropriate authorities, such as the Alaska Division of Insurance or law enforcement. Fraudulent activity can result in significant legal consequences, and underwriters must ensure they follow the proper procedure, maintain the integrity of the insurance process.